Welcome to Tech Money Madness, your daily U.S. stock market podcast. Tuesday, August 25th, 2026.
Hey, everyone.
So if you're looking at the broad tech rebound today, it really feels like investors are just aggressively positioning themselves ahead of Nvidia's earnings, right?
Yeah, totally. And you also have this massive shift toward bond market optimism right now.
Right, which is wild.
It is. Options traders are placing just, these huge bets on a bond rally because there's this growing expectation that the great hike cycle might actually be behind us.
Yeah, the sentiment is definitely shifting. But today, we're actually doing a massive deep dive into a huge stack of daily market briefings.
Oh, there's so much to unpack today.
There really is. We want to synthesize all this data to figure out where the world's biggest money is actually moving right now. Because, if you look past the daily ticker shocks, there's a really fascinating kind of hidden story here.
A story about the search for safe havens, really.
Exactly, in a world that is fundamentally fracturing. So let's jump into our top stories. Story A is obviously Nvidia. They report earnings tomorrow. Yep, the big one.
And it is the central event for tech investors. The numbers analysts are projecting are just staggering. They're looking at a record $91 billion in revenue.
Which is, I think, a 95% year-over-year growth rate. It's almost hard to wrap your head around.
It really is. But what caught my eye in the briefings wasn't actually the revenue numbers. It was this specific strategic move they're making.
Oh, the financing options.
Yes. Nvidia is actively offering new financing options to expand its customer base. And I'm honestly just confused by this. Why is the most valuable chip maker on Earth suddenly acting like a commercial bank?
Well, it really comes down to structural vulnerability. I mean, Nvidia has a pretty severe concentration risk problem right now.
Because they rely so heavily on the big guys.
Right. The vast majority of their revenue comes from just a handful of hyperscalers.
Yeah.
Meta, Alphabet, Microsoft, Amazon.
The one's locked in that massive data center arms race. Exactly. They're buying tens of thousands of GPUs at a time. But if just one of those hyperscalers decides to, trim their capital expenditures, Nvidia's forward guidance would basically collapse.
Wow, okay. So by offering vendor financing, they're basically lending money to smaller AI startups or enterprise companies.
Yep. Even sovereign nations. They want to make sure these massive H100 and B200 clusters are accessible to a wider buyer base. They're artificially propping up a secondary layer of demand.
So they have a cushion if Google or Microsoft ever taps the brakes.
Precisely. It's a defensive mechanism, and the stakes for this are enormous. Any guidance missed from Nvidia could ripple across the entire semiconductor complex.
Oh, for sure. The sources even note that TSMC is incredibly heavily reliant here. Over 20% of TSMC's revenue comes directly from Nvidia.
Yeah, and some analysts are projecting a massive 182% upside for TSMC by 2030. But, that assumes this whole centralized heavy compute infrastructure build-out just continues uninterrupted.
Right. Which brings us perfectly to story C in our briefings.
Yeah.
Because that assumption is exactly what Apple is targeting right now with a massive countermove.
The new Mac releases.
Yeah. Apple just unveiled the new M5 Max and M5 Ultra Max Studios and Mac Minis. And they are explicitly targeting AI developers with this hardware.
Right. They want them to run and fine-tune large language models locally, right on their desks.
Exactly. It feels like Nvidia is selling massive industrial power plants while Apple is suddenly trying to sell everyone a personal solar panel.
That is actually a really great analogy. It's a totally capital-light strategy. Apple is leveraging their hardware design prowess instead of building out this ridiculously expensive data center infrastructure.
And analysts seem to love it. One of the briefings mentioned an analyst reiterating an outperform rating based on this. But I have to ask, if Apple's local capital-light strategy wins out, does Nvidia's hyperscaler bubble just pop?
Well, it definitely cools down the data center arms race. You have to remember, inference, which is actually running the AI model once it's trained, requires massive amounts of memory.
Right.
Apple's unified memory architecture is perfect for that. If developers realize they don't need to rent supercomputers by the hour in the cloud to deploy AI, that changes everything.
It totally rewrites the hardware landscape.
Yeah, and it would severely re-rate TSMC and the server manufacturers who are banking on that endless cloud expansion.
Okay, so that's how the tech is being built. Let's move to story B and talk about who is actually buying it. Because if Apple is taking a capital-light approach, Berkshire Hathaway is doing the exact opposite.
Oh, the Alphabet purchase. Yeah, this is a major signal from Wall Street's smartest money.
I mean, I saw this in the filings, and I literally did a double take. Berkshire Hathaway executed a $10 billion private placement purchase of Alphabet stock.
Yep, they bought it directly from the company, split between Class A and Class C shares.
And this makes Alphabet their third largest holding now, right? Tying for third.
Yeah, it represents about 10.2% of their entire portfolio now.
Which is just wild to me.
Yeah.
Warren Buffett historically avoided tech companies because he said he didn't understand them. What is incoming CEO Greg Abel doing here?
Well, Greg Abel is deploying Berkshire's $365.5 billion cash pile way more aggressively than Buffett ever did in tech. And you really have to view mega-cap tech through a different lens today.
How so?
Alphabet isn't just a software company anymore. It operates almost like a sovereign entity. It has a near monopoly on global search, unparalleled data access, and these incredibly robust inflation-resistant cash flows.
So big money is basically rotating into mega cap tech on its own terms.
Exactly. Even with the severe concentration risk, they are doing it because the alternatives are worse. Cash loses purchasing power, right?
Right, which perfectly segues into Story D, because everyday investors are doing the exact same thing with alternative assets.
The debasement trade.
Yes, Bitcoin just surged past $81,000. It's being driven by renewed inflows into those spot Bitcoin ETFs and just a generally improving risk appetite.
Yeah, people are rotating into gold, Bitcoin, and other hard assets to hedge against U.S. government spending and dollar weakness.
And the catalyst for this specific rally?
A lot of it points to Treasury Secretary Bessent's recent bond market interventions. That really kicked the debasement trade into overdrive.
It's just so ironic to me. You have Greg Abel buying $10 billion of Alphabet, and you have crypto traders pushing Bitcoin over $81,000. Aren't these just two different generations doing the exact same thing?
Fundamentally, yeah. They are both desperately looking for a safe place to park their cash away from fiat currency.
But not everyone is buying into the Treasury's narrative, right?
Definitely not. I mean, heavyweights like Stanley Druckenmiller are deeply skeptical. He doesn't believe the Treasury intervention will actually sustain meaningful yield declines. He thinks you can't just artificially suppress yields forever while running massive fiscal deficits.
So there's this huge search for safety in investment portfolios. But according to our briefings, this search for safety is also physically reshaping the world.
Oh, the geopolitical fractures. This is where it gets really real.
Yeah, let's look at the supply chain data. Google is relocating all of its Pixel smartphone and smartwatch production out of China by 2027.
They are actively diversifying that supply chain to reduce risk.
And while they are doing that, China is building a massive financial hedge against the U.S.
Right, the CIPS expansion.
Yeah, they're expanding their CIPS system, which is an alternative to SWIFT, specifically to shield transactions involving Iran from U.S. sanctions.
And at the same time, Iran and Oman are exploring a jointly managed shipping route in the Strait of Hormuz.
Just completely circumventing secondary sanctions. When you look at all these sources together, are we officially watching the death of globalization? I mean, it sounds like we're entering a splinter net of physical trade.
Well, I wouldn't call it the death of trade, but it is a massive shift. Supply chains of payment systems are becoming totally siloed, and that dramatically increases the baseline friction and the costs in the global financial system.
Because everyone has to build duplicate systems.
Exactly. We're moving to a post-China manufacturing world, and honestly, traditional finance is scrambling just to keep up.
Oh, like that note about Moody's.
Yeah. Moody's is integrating credit ratings directly into Google Cloud's Gemini AI. The data landscape is getting so complex with all these fractured trade routes, they literally need advanced AI just to track the shifting geopolitical map.
That is just wild. Okay, let's bring this all back home to the domestic reality check. Segment 3 are market movers.
Let's do it.
So how does all this high-level geopolitical and macro maneuvering actually trickle down to the everyday consumer? Because we're approaching a very critical deadline.
The November 3rd election.
Exactly. It's just 10 weeks away.
Yeah.
And Wall Street is actively pricing in massive political risk regarding the debt ceiling, fiscal policy, tech regulation, just general stability risk, regardless of the outcome.
Right. And you know, we keep hearing about the K-shaped economy supposedly narrowing. But household balance sheets are still really stressed.
Look at Dick's Sporting Goods, ticker symbol DKS. The stock just plummeted roughly 30% today.
Yeah, they reported a fiscal second quarter miss.
And they specifically cited a very challenging footwear market. Everyday people are too squeezed to buy sneakers.
But then you look at institutional capital, and it's a totally different story.
Exactly. Institutional investors are aggressively bidding up commercial real estate right now, despite all this macro uncertainty. Waymo is expanding robotaxis to Germany by 2027. SpaceX is building a $100 billion spaceport in Louisiana.
It's a jarring contradiction.
It really is. Wait, so they have the cash to build a $100 billion spaceport, but everyday people can't buy shoes. What does that actually say about the supposed narrowing of the economic divide?
It says the micro-reality for retail consumers remains highly, highly fragile. The macro numbers look optimistic, with the bond rallies and tech booms we talked about, but that's institutional liquidity.
The retail consumer isn't feeling it?
Not at all. Look at the housing market. Cash buyers are losing their grip as inventory increases and prices soften.
Because regular people who need mortgages are paralyzed by the rates.
Exactly. And this is why everyone on Wall Street is watching Wednesday's earnings tests for CrowdStrike, ticker CRWD, and Salesforce, ticker CRM.
Right, to see if their recent rallies actually hold substance. Why are those two so critical?
Because they are the bellwethers for broader corporate health. If the consumer is stressed, eventually companies cut back on their B2B software spending. So those earnings will tell us if the stress at the bottom is finally hitting the corporate balance sheets at the top.
Okay, so let's quickly wrap up with segment 4, our key themes and outlook. We have 5 key themes today.
Right. Theme 1. NVIDIA's earnings tomorrow will absolutely set the tone for tech and semiconductors. It is a binary event for the entire AI ecosystem.
Theme 2. The debasement trade is officially back. Bitcoin, gold, alternative assets, they are all rallying on fiscal unease.
Theme 3. Big money is rotating into mega-cap tech on its own terms, which we clearly saw with Berkshire's $10 billion Alphabet purchase.
Theme 4. AI strategy is being completely redefined at the hardware level. You have Apple's capital-light approach going head-to-head with the massive data center arms race.
And finally, Theme 5. Geopolitical fractures are fundamentally reshaping trade and finance, from the Iran-Oman shipping talks to China's CIPS expansion.
And all of that is increasingly influencing market risk assessments as we head into this election, just 10 weeks away.
There is one final thought here that wasn't explicitly spelled out in the briefings, but it's really worth mulling over.
Oh, what's that?
Well, think about it. If Apple is successfully pushing AI processing down to the local individual device level, and at the exact same time, mega corporations and sovereign nations are building localized, independent supply chains and payment networks,
Yeah.
are we witnessing the end of the cloud as we know it, and maybe even the end of global interconnectedness as a concept? We might be entering this era of hyper-localization, not just in where our data lives, but in how the entire physical world operates. It's a huge paradigm shift.
That is a fascinating thing to think about. It really reframes everything we've talked about today.
It definitely changes how you look at your portfolio, that's for sure.
Absolutely. Well, that's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.